The next topic is monetary aggregate or monetary aggregates. We talked about money, the functions of money, the sources of money supply, and the concept of money multiplier till now. Now let's talk about monetary aggregates. And why do we need monetary aggregates? So money supply in an economy can be of various liquidity. And what do we mean by liquidity is how easily you can take the money and spend it. Now let's think of a scenario where you have money in your wallet. Okay, and let's imagine you have a lot of money in your wallet. You can spend this money right now. Like if I ask you for some money, you can give it to me. There's no restriction. And that is the currency with the public, that the currency you can spend with the highest amount of liquidity. Okay. Then you have, so this is the money with you. Then you might have a bank account. So you might have some money in the bank. So in the bank, we have various kinds of deposits. We can have savings account, we can have recurring deposit, we can have fixed deposit. Now what do these mean? Savings account is the money, basically instead of keeping it in the cupboard, you put it in the bank, you can go and take it any time you want. Recurring deposit is when you put some money every month and you build up your savings. And fixed deposit is when you put a sum of money, let's say 1 lakh rupees, for a certain period of time, let's say 1 year, and you only get it after 1 year. And after 1 year, you also get some interest with 1 lakh, so that that's interest, and that's how my bank works. If that's how banks work. If you remember the last video, yes. So now we have. So initially you had money in cash. Okay. Now you have money with the banks. This money has various terms that you will have to remember. Now, savings account are also known as demand deposits. Now, why are they known as demand deposits? It's because whenever you demand that particular money, the bank is liable to pay you that money. So this is almost like having in your wallet. Now, it's not safe to carry, let's say, 50 lakhs in your wallet, but it's okay to keep it in the bank. And that's why we have demand deposits. At the same time, we also have recurring deposit and fixed deposit that mostly have a certain time period for which that money will be locked. And this is called time deposits. And this mostly refers to fixed deposits. That means you can only take it after that particular time. For example, I have a fixed deposit of 1 lakh. I need money right now. I cannot take that money. I'll have to go to the bank, do some procedure, break that fixed deposit, and then take the money out. So now we have cash, we have demand deposits, time deposits, and we also put money in post office. And this money can again be divided into savings accounts or savings deposit and time deposits or fixed accounts or fixed deposits. So these are the ways in which our money supply can be stored. And liquidity is when, how easy is it for you to take the money? For example, if you want to take money out of your wallet, it is very easy. If you want to take money out of your demand deposit, you can just Google Pay money from your demand deposits. That's also great. Time deposit is not that liquid. It's quite difficult to get money. You have to go to the bank, you have to break the FD. So, not very happy. Then post office savings account is also quite liquid, because it's a savings account. Savings account means it has to be liquid. And again, time deposits are not very liquid. So this is the liquidity story of monetary aggregates. And just to tell us about the liquidity of all this, the RBI, which is the central bank of the country, releases a list of monetary aggregates to tell us what is the liquidity of certain kinds of instruments. Okay. So for example, if you want your cash to be extremely liquid, how you should keep it, so on and so forth. So we have 4 monetary aggregates called M1, M2, M3 and M4. Now M1 is the cash that is in your wallet and the demand deposits that you have with the banks. Now these two, whenever you ask for it, they have to give it to you. Now M2 is M1 plus the savings account of post office. Now this is also quite liquid, because it's a savings account, and when you go to the post office, they have to give you that money whenever you need it. Third one is currency or the money in your wallet plus the demand deposits plus time deposit with banks. Now, to make it a little simpler, this is M1 plus time deposits of banks. And the final one is M3. So in M3 we have M1 which is currency plus demand deposits of banks and time deposit banks. That means we have everything that is currency and banking, we have everything included in M3. So in M4, what we have to do is just add the savings account and the time deposit of post office. That is this. But just note that there's you exclude the national savings certificate. That's the only thing you have to remember for this. So we have M1, M2, M3 and M4. M1 is the most liquid, and as we go down, the liquidity keeps decreasing. Now, there's another term that we use to explain the liquidity of these monetary aggregates or monetary instruments. It's called narrow money and it's called broad money. Now, narrow money is the most liquid, whereas broad money, the liquidity is low, but it is broader. Okay, the concept of money in this case is broader. So narrow and broad money are two classifications of money based on its liquidity. Narrow money is M1 and M2, and broad money is M3 and M4. And here one more thing you can note is that M3 is used as the aggregate monetary resource. That means M3 is the money that is mostly used when we talk about money, or the most common reference of money comes from M3. What is M3? It is basically the money in your wallet and everything in the bank. We are excluding post office in this case. Okay, so these are the monetary aggregates of money that is published by RBI, and what they tell you is the measures of money supply and how liquid each of these instruments that you put your money in are. And just one more thing, adding to a small thing, is M0. There's something called M0, and this is also known as the high-powered money, reserve money, or monetary base. Now, I introduced this only to let you understand this term that sounds so very complicated, okay, but in reality is very simple. M0 is all the money that has been issued by the RBI. That means earlier we talked about how RBI prints money, and that's the money we all use. Now, the money that the RBI prints, or the rupee, that currency becomes the monetary base for all transactions in this economy, and hence it's known as monetary base. And it is also called high-powered money, and this is basically all the money that the RBI has printed. In other words, it is all the liabilities the RBI has. Okay, that means the RBI has printed the money. If people go back to it with the money because it's a guarantor, they have to give that money to it. So it's a liability of the RBI. So M0, also known as high-powered money, reserve money, or monetary base, is in simple terms just all the money that is in our economy, all the money that is printed by RBI. So that's about monetary aggregates. We see where all we can store our money and what are the various measures of liquidity that each different storage of money provides to us. And finally, we talked about high-powered money, or monetary base, or reserve money, which is basically all the liability of RBI, or in other words, all the money that the RBI has printed. Thank you.